Should you be worried about rising interest rates? Or what about rising inflation? And now there's even talk about a recession. In this week's Property Insider Chat, Dr. Andrew Wilson and I will explain to you what's ahead. And yes, there has been a significant change in the message from the Reserve Bank. If you want to keep up to date with what's happening in our property markets and the economy, please subscribe to this YouTube channel and click the little bell icon so you can be kept up to date each time a new show comes out. Interest rate speculation is scaring those who've got a mortgage. Inflation talk scaring millions of Australians who never experienced inflation. And now recession talk's finding its way into the media. And in general, these matters shouldn't be a concern. But no one likes change. And there's been another change in the last week or so. It seems the Reserve Bank has dramatically changed its guidelines for a rise in official interest rates, indicating that higher rates are now likely to come sooner rather than later. So I'd like to discuss the potential implications of this with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Yes, hello, Michael. It's been a very interesting week, hasn't it, reading the tea leaves? And the tea leaves look a little different now than they have for the last year or so.
Yes, they have. I mean, the Reserve Bank's consistently stated that the rate rise was dependent, firstly, on inflation being between 2 and 3%, its target range, but also about wages going up as well. But the latest minutes from the Reserve Bank meeting showed a change in their thinking.
The traditional parameters has been that we get higher prices through an overheated economy where we have supply falling behind demand. That ends up with wages rising or chasing higher prices, which then acts to rise prices again. And then we get wages chasing those higher prices again. And that's called a wages prices spiral. And we've had a few episodes of that, particularly back mid-70s and 80s. And they've flipped open the textbooks and thinking, okay, high inflation, we've got to start thinking about higher interest rates. And of course, that's a wonderful opportunity for the media to home in on those that scary headline, interest rates to rise. So we've had a lot of that being fueled in the media, the prospect of higher rates. And of course, banks, we know, have very skinny margins at the moment with basically zero interest rates. And of course, they're chomping at the bit for higher rates as well. So a lot of upward pressure, a lot of discussion on higher interest rates. The Reserve Bank hasn't added to that speculation until recently. It's been quite firm and justifiably so, in my opinion, that we need to have both the levers of higher inflation and higher wages before we started thinking about pushing up interest rates. But they've now certainly flip-flopped on those key factors, I believe. They're now saying, as you suggested, that might come sooner rather than later. They've eliminated the word patient from their description of the outlook in terms of their decision. So I'm not sure why they wouldn't be patient. Why would be impatient, Michael? Where are these terrible factors that are meaning we have to act sooner rather than later? Now, obviously, nothing has changed in the data or the essential data that the Reserve Bank uses as its guidelines for interest rate changes. Our inflation data is out this week, and it's likely to show another increase. Of course, the headline inflation rate was 3.7%, which was obviously of concern, given it's considerably higher than where it has been tracking. When we looked deeper into the inflation number, we did see that it was reflecting these COVID-related supply constraints, high fuel costs as a result of shortage of oil supply. Underlying oil, of course, is not in short supply. It's just been the surge in demand post the lockdown period, which has caught suppliers short in terms of being able to match that demand. Of course, another factor was house building costs. They've gone through the roof as a result of the home builder package from the federal government. Of course, that's now expired, but that meant that we had a surge in demand for housing and we didn't have the labour and materials to match that demand. Therefore, building costs have increased. But of course, since then, we've seen building approvals normalising post the home builder package. And one of the other factors that we've seen, which is not really related to COVID, but has been high home rents, and they've been rising through other factors. But the essential elements of high inflation recently have been COVID-related supply constraints with oil, and in Australia's case, house building costs. Now, house building costs, as I track them, Michael, have continued to rise and will add again to higher inflation over the March quarter. We've seen my index rise from 15.7% for house building costs over the December quarter, up by now 19.8%, so higher costs. House rents have increased from 6.2%. These are year-on-year increases, by the way, Michael, from the December quarter last year, up 6.2%, now up 10.3% over the March quarter. But the price of oil has fallen from an 83.3% increase over, which was, of course, quite spectacular. And we know that with those $2 plus a litre prices we had to pay, but that's now reduced while still increasing over the March quarter. Price of oil is now up by 66.7% compared to that 83.3%. So some downward pressure there from oil, but certainly upward pressure from other factors. So I would suggest that we're going to see perhaps a 4% plus headline result for the inflation data for the March quarter. Not a real surprise there. And when we look at still at that 4% plus a number, it's half that of the US at the moment. So we don't really have anywhere near the problem that the US has. But notwithstanding inflation, as we've discussed previously, Michael, that's really half the equation, or because we really need to have, as the Reserve Bank has been consistently telling us, we need to have consistent wages growth higher or pointing towards that increase in underlying inflation. So the real data was or is to come out on the 19th of May, which is the wages index data for the March quarter. But it seems that the chat is generally now that that's going to be irrelevant, that regardless of that number, which will come following what was another weak number, a benign number, 2.3% annualized wages growth over the December quarter. I would have thought the Reserve Bank has clearly been indicating that it needed a wages index data pointing to higher than 3% annualized, or certainly close to that, but not just a one-off, that we needed a couple of quarters to show us that wages were starting to chase prices. So it looks like from the commentary, and of course a lot of the usual suspects are pushing that to mean a certainty an interest rate rise prior to getting those consistent wage rises. So, and the speculation is very strong now that interest rates will increase in June, and maybe the Reserve Bank's just been dragged along by the momentum in the market and the media for rate rises. But certainly it cannot justify it based on previous commentary that there needs to be consistent high wages growth to meet the traditional parameters, higher wages chasing higher prices. So if we do get a June rise, Michael, and let's not get ahead of ourselves, there'll be some pretty interesting questions directed at the Reserve Bank that if we remember, interestingly enough, we are in an election mode at the moment, that if we go back 3 years to the previous federal election, the Reserve Bank was quite consistently telling us that the next interest rate rise would be up. And they had been telling us that for quite some time. And as we all know, following the last general election, we saw the Reserve Bank flip-flop and slash interest rates over the second half of 2019. So a little bit of form there, but there will be some interesting, perhaps hard questions for the Reserve Bank to answer, given the commentary over the last year, if they do decide to raise interest rates in June.
Well, we're going to find out sooner rather than later. The inflation figures coming in soon. There's going to be a May Reserve Bank meeting. Then the wages are going to come out. So lots of speculation moving forward. Andrew, turning to the auction markets now, property markets, they've been disrupted. We've had multiple holidays, school holidays, Easter, Anzac Day, long weekend. Yet I was surprised how many auctions were conducted over this last long weekend. And in general, auction clearance rates remained in favour of sellers.
Yes, a bit of a rebound in terms of activity level. Certainly there was no activity the previous weekend because it was Easter. But we have the Anzac Day long weekend, so it's back-to-back holidays, Michael. But yes, there were some, certainly enough auctions to give us a reasonable insight into the market, and really nothing much changed. Melbourne had quite a good clearance rate, above 70%, which was actually higher than the fortnight previous, which was Super Saturday. So another solid result there from sellers, and just under 600 auctions in Melbourne, a little bit lower than the same holiday weekend last year, Michael, but nonetheless still plenty of choices for buyers there. The smaller markets performed with the higher numbers quite adequately as well. Again, Adelaide, the strong performer there. And Canberra also, although their numbers were quite low by comparison with the other capitals and recent results for Canberra. But Sydney was a bit of a standout, Michael. It certainly had a high number of auctions for a holiday weekend, over 600, similar to the year before. But its clearance rate fell down under 65%. So some signs there that Sydney market is just easing now. The trend's certainly been downwards over the past month or so, but it was affected by the floods, which produced a lot of withdrawals from the auction market at that time. So maybe still recovering, but the big picture in terms of Melbourne and Sydney, particularly, Michael, over this Anzac Day long weekend, is that we just have really a shortage of higher priced properties, which is what we do see over the holiday period. So it won't be until next weekend that we have a normalised market with the usual mix of property price types.
What we're noticing on the ground, Andrew, is that there's a flight to quality. Buyers are being more careful. They're not being driven by FOMO anymore. They've got a choice of properties. They're doing their homework, their due diligence, but good properties are still selling strongly.
Yes, well, we know that we've come through a very strong period, particularly in Melbourne and Sydney, and affordability barriers have quietened the market. I guess we could call that the natural stabiliser, but there's nothing pushing affordability downwards significantly other than higher prices. The appetite is still quite strong there. A lot of pent-up demand has been satisfied, of course, so buyer numbers have eased, but it's still quite a robust market, Michael. The latest prices data in those high-flying Melbourne and Sydney markets shows it's a steady price environment. Prices certainly aren't falling; they're more just steady, and I think that means that the prices are holding from those record levels. But certainly growth levels can't be sustained at what we saw last year because we don't have the capacity to continue to push prices up. But buyer appetite is still quite healthy, Michael.
Sure. And there's no desperate vendors at the moment, so there's no reason for prices to crash like people are suggesting. Well, I look forward to catching up with you next week because at that stage, we'll understand what the inflation figure is and it'll give us a few more things to discuss. Thanks, Andrew.
Thank you, Michael.